All right, folks, the NASDAQ is higher, but I can tell you, there's some real carnage out there. I can tell you a lot of my positions are getting hammered today. And my next guest says that it's another example of why you never get comfortable. I'm going to bring in now Adam Kobeissi, Kobeissi Letter, editor-in-chief, to discuss. You posted this yesterday in the IBM news. Everyone loved IBM. You know, I got to tell you, a large percentage of my guests in the last 4 months, IBM, Quantum's coming, they've reinvented themselves, new CEO, bam, worst session in the history of the company.
Right, and that's why we said don't get comfortable in this AI era, because the stocks that are the most hated stocks quickly become the most loved stocks, and vice versa. I mean, look at what happened with Intel, with Micron. The market now with AI, and really since 2022, a year is like 10 years now. And those who are able to continue to adapt, and that's not just for companies, but for investors, and evolve with the way the market is moving. I know last time I was on, I talked about this bottleneck trade that we've been following. Right. There's always this new bottleneck. Right. Those are the people who are winning the most in this market. So I think comfort is really the biggest enemy in the AI era.
Yeah. If you think this is an efficient market, folks, you're absolutely not. It never has been, but certainly not now with these daily changes. You also recently posted something about the foreigners selling the Korean market. This has actually been happening for a long time. What I'm concerned about is the Koreans. You had 100 accounts for 52 million people. People were selling their life insurance policies to buy stocks. They even had a birth boom from the worst birth rate in the world for 1 month, the best. So they're excited. Now maybe they've gone too far. What happens in this? Because I feel what's happening to the Cosby and even to its memory here is more emotionally driven than fundamentally driven.
Yeah, it definitely is emotionally driven. And not only is it emotionally driven, but the leverage that we're seeing is amplifying that by multiple times over. I'll give you an example. SK Hynix, their biggest company, has $20 billion in levered ETFs. For comparison, NVIDIA has around $5 billion. Right. So there's almost 4 times as much leverage in that stock alone than NVIDIA, and that stock's only a fifth of the size of NVIDIA. So I think what you're seeing is excessive amounts of leverage coupled with a lot of speculation, a lot of excitement. And some people that are on, a little bit more removed from that are saying maybe now's some time to start taking some chips off the table. I don't think that's bearish for U.S. stocks in any way. I think they're in a way a little bit isolated from what's happening.
Right. I think so too. Although it's also a cautionary tale for us. We're nowhere near that mania right now.
All right, we do love leverage, and
we love leverage.
You can't ignore that.
Leverage. All right. So the flip in the script, with the semiconductors and versus software. Do you sense that this is a change, that a change is coming, and maybe it's time to look at the semis, maybe it's time to look at hyperscalers?
So what our thesis has been now is, for a long time, the Magnificent Seven needed to move higher for the market to move higher. And everyone thought if the Magnificent Seven corrects, we're going to crash. Well, take a look what happened. Almost all the Mag 7 stocks have fallen close to at least 20% from their highs. Looking at Microsoft, look at the Googles of the world. Even Apple was down 15, 20%, NVIDIA. But the S&P is 1% away from a record high. Why? Because these memory names subbed in. Well, we think a rotation is going to happen back into the Mag 7, into large cap tech, and that's going to be the catalyst that takes the S&P to 8,000, because these names like NVIDIA, which by the way is now trading cheaper than the S&P 500 on a forward earnings basis, is going to reclaim the lead here and take us to record highs again.
So large cap technology, large cap growth is what you like here.
We love it here.
You like it here.
Yeah.
What would you get out of then if to be in that?
I think a lot of these memory names that have rallied a lot, like the SanDisk and the Microns of the world, I'm not saying that there's an imminent crash coming, but I don't think you're going to perform better in those names over the next 3 to 6 months than you would in the large cap tech names that lagged because of those stocks.
Right.
And that's exactly why, the equal weight S&P just hit 31 all-time highs year to date. That's the most since 2021. The market broadened, the rally broadened. Now we're coming right back into big tech, and I think that's actually bullish for the S&P 500.
All right, you got less than a minute to go, about 40 seconds. Buy the dips in gold and bonds.
Absolutely.
So we just had Newton on. He's worried about that 10-year yield. He thinks it might still trend higher. You think any kind of move here, though, maybe it's a buying option?
Yeah, and I think, the 10 years back to 4.6. I think rate hike expectations are way too aggressive right now. I think we could end the year without any hikes at all. And on the flip side, gold is starting to find support around 4,000. The dollar has been very strong. I think it's due for a pullback. And if anything less than the extreme hawkishness that's expected by the Fed materializes, I think gold and bonds are going to be very strong. Gold remains strong from a geopolitical and as well as an uncertainty perspective for safe haven investors. And these are some of the most hated assets in the market.
Right.
You know me, I love buying the hated stuff.
Right.
So
good stuff, my man. By the way, I agree with everything you just said. Just about everything.
Thank you.
You're looking good. All right, folks.